Warren Buffett just walked away from BYD, and a top Chinese CEO says the industry already has its Evergrande. If that's even partly true, it won't stay in China. Prices, suppliers, and exports all feel it next. Today, I'll connect the dots. The price war math, policy support baked into profits, supplier terms stretched to the limit, and those zero-mile used sales you keep hearing about. And at the end, I'll give you 4 simple dials to track so you can see the turn before the headlines. Warren Buffett just walked away from China's EV champion. After 17 years riding BYD's rise, Berkshire Hathaway has now fully exited. That move alone doesn't prove there's a bubble, but it changes the conversation. When the world's most patient investor decides the margin of safety is gone, you pay attention. Today we're pulling apart the puzzle pieces. Relentless price wars, policy support on both the demand and supply sides, cash flow boosted by very long supplier payment cycles, the practice of exporting zero-mile used cars that can flatter headline sales, and the blunt warning from Great Wall Motors chairman that the industry already has its own Evergrande. It just hasn't burst yet. If that's even partly true, the shock won't stop in China. It runs through supply chains to Europe, to North America, and to Brazil. But that wasn't the whole story. And the numbers behind the headlines are the part most people miss. The exit signal. Why Berkshire left. Berkshire's relationship with BYD started back in 2008. Over the next decade plus, the position turned into a monster winner as China's EV market exploded. Starting in 2022, Berkshire began to trim. By early 2025, filings and financial press reports showed the stake at zero. No panic, no insults. Just the classic Buffett playbook. When upside compresses and downside risk grows, you take the win and step aside. That doesn't make BYD a bad company. It says the risk-reward changed, and if it changed for a famously long-term, low-drama investor, you have to ask, what's different now compared with 5 years ago? Clue number 1. The economy of price wars. The price war economy. Volume isn't the same as value. China is the world's most competitive EV arena. Dozens of brands fight in overlapping price bands, releasing variant after variant to cover every niche. On paper, that creates stunning unit volumes. In reality, it pressures margins, complexity, and cash. Contrast that with a company like Tesla, which runs a short lineup and pushes software, services, and scale. Chinese rivals that pursue breadth, 20 or 30 models in market, shoulder higher complexity costs and weaker pricing power. You can move a lot of cars and still feel poorer at the end of the quarter if the discounting is heavy enough. And when margins thin out, the hunt for oxygen moves from the P&L to the balance sheet. Subsidies on both ends. How policy shapes the market. A big part of the EV story is policy. Consumers in many places receive tax breaks or fee waivers. Manufacturers receive grants, incentives, or credits. This is not unique to China, but the scale and persistence matter. If you open BYD's recent financial statements, you'll see categories such as government grants and subsidies and other income/gains. Those line items are legitimate, but they also tell you a chunk of profitability is policy-linked. Industry analysts have pointed out that subsidy support has at times represented a material share of reported profit. The investment question is simple. If support rotates or fades, do volumes and margins still hold up? Even with policy help, companies still need cash, and a lot of that cash hasn't been coming from customers. It's been coming from suppliers. The hidden credit line, when suppliers become the bank. Here's the uncomfortable part that keeps resurfacing in coverage and analyst notes. Several Chinese automakers have leaned on very long days payable outstanding TPO, the number of days they take to pay suppliers. Independent analyses have estimated well over 100 days for some big names, and around 9 months for certain periods at BYD, figures far longer than typical Japanese or US practices. Is long DPO illegal? No. But pushing payment terms that far shifts working capital strain to the weakest link, the supplier. In at least one recent year, a major chunk of operating cash flow at a leading car maker came from stretching payables rather than from core profitability. That props up cash flow now, but it's a pressure cooker for the supply base. If small suppliers can't finance the gap, quality and delivery risk creep in, right when the brand is fighting a price war. And when even that isn't enough to make the numbers look pretty, something else shows up in the sales line. Zero-mile used. When exports flatter the headline, Ray Orta's investigations and follow-on coverage describe channels where vehicles are registered domestically and then exported as used cars, often with 0 miles. For a manufacturer, that can boost reported sales and help clear inventory. For the market, it blurs the picture of real end demand. State media commentary has since called for a crackdown to standardize the practice. Important nuance. This doesn't mean every brand does it, or that it's illegal by default. It means that in a system full of targets, rebates, and local incentives, behavior drifts. When the scoreboard rewards units, people find ways to put points on the board. And that's exactly the backdrop for the quote that shook the industry. The Evergrande of autos already exists. The GWM warning. In late May 2025, Wei Jianjun, chairman of Great Wall Motor, gave an unusually frank interview. His line was simple and explosive. Now Evergrande in the automobile industry already exists, but it has not collapsed. He didn't name a company. He did call the industry unhealthy. The message landed because everyone understood the reference. Evergrande was the Chinese property developer that became the symbol of a bubble and a painful unwinding. Is the comparison perfect? No. Real estate and autos are different animals. But the spirit of the warning is clear. Somewhere in this system, there may already be a large, fragile player being kept afloat by credit, policy, or accounting oxygen. When that oxygen thins, the problems surface fast. So if a big player stumbles, how far does the shockwave travel? Too big to fail, or too connected to fail? Unlike property, autos are global. Supply chains stretch across Asia, Europe, and the Americas. Finished vehicles travel and pricing ripples across borders. If a large car maker got into trouble, local or central authorities could step in, not necessarily to save shareholders, but to keep jobs, exports, and supply chains intact. China has used targeted rescues and policy nudges in other sectors when macro or social stability was at stake. It's reasonable to expect interventions, mergers, or structured rescues if needed. That's why this story doesn't stay in China. A disorderly shakeout could send discounts into export markets, pressure suppliers that also serve European and American brands, and turbocharge tariff debates. For consumers, cheap deals might appear in the short run, but service networks, parts availability, and resale values become big question marks if a brand consolidates or exits. So how do you read the dashboard before anything breaks? You watch the dials that move first. The 4 dials that tell the truth. Dial 1. Inventory and discounting. Steep quarter-end promotions, rapid new model cycles, and surges in exports are classic signs of throughput stress. If you see big blitz discounts followed by quick facelifts, the company may be buying volume. Dial 2. Supplier terms. DPO. Normalizing payment periods is a healthy sign. Stubbornly long DPO means cash is still being borrowed from the supply base. When suppliers revolt by tightening credit or demanding cash on delivery, production plans can fall apart overnight. Dial 3. Cash flow quality. Separate operating cash flow from working capital effects. If cash looks great but payables ballooned, that isn't durable. Track receivables too. If dealers and export channels owe more each quarter, sell-through may be lagging sell-in. Lines like government grants and subsidies and other income aren't inherently bad, but a rising share of profit from these buckets means the business is more exposed to policy rotation or trade actions in target markets. Combine that with heavy price promotions, and you've got a business that works only when everything goes right. Put those dials together, and you can see the story before the headlines catch up. Why Buffett's move matters more than a hot take. Berkshire's exit isn't a tweet or a rumor. It's the end of a 17-year investment by a firm that doesn't chase headlines. It says, the straightforward, compounding phase is behind us. Now come the hard yards. Tighter economics, harsher competition, and more reliance on policy or financial engineering. If you're a long-term investor, that's a perfectly rational moment to move on. For operators inside the industry, the message cuts the other way. This isn't the end of EVs, it's the start of the discipline era. Platforms have to converge, catalogs have to shrink, and supplier relationships have to be rebuilt on terms that don't choke the base. Whoever pulls that off wins the next decade. And if you want a quick mental model for the next year, here it is. 3 scenarios to watch. Soft landing. Most likely. Policy support eases but doesn't vanish. A few mergers, some model cuts, standardization of supplier terms, and gradual price normalization. Consumers still get deals. The weakest brands fold into stronger ones. Bumpy but managed. One large player hits a funding wall. A structured rescue or local government bailout follows. Suppliers take a hit, export prices wobble, tariffs get louder. The system absorbs the shock, but confidence takes time to rebuild. Hard shock, low probability, high impact. Multiple failures line up before policymakers react. Supply chains seize, delivery times spike, and a short, sharp recession hits the sector. This is the scenario everyone wants to avoid, and it's exactly why you're hearing words like standardized payment periods and clean up unhealthy practices. After the music slows, the EV revolution isn't going away. Batteries keep improving. Platforms keep getting smarter. and consumers still want cheaper running costs and quicker acceleration. What is going away is the illusion that you can discount forever. Pay suppliers in slow motion and call it sustainable growth. If the tide goes out, the balance sheets will tell you who had a swimsuit. Watch inventory, DPO, cash flow quality, and policy dependence. Those 4 dials will show you, quarter by quarter, which brands are building real businesses and which ones were surfing on borrowed time. If this cut through the noise, tap like and don't forget to subscribe. Then tell me in the comments which dial you want next: inventory, DPO, cash flow quality, or policy dependence. Let's see what the audience's top pick is. Thanks for watching. See you in the next video. Until then, take care and drive safe.